Welcome back to the Behind the Well show. Roger Abel here with Elias Randall. What's new? I need Doug here to do the big introduction.
Yeah,
Elias,
I agree. I think
big kahuna, new sheriff in town.
your intro's pretty weak when you start comparing it to Doug Wagner's.
Maybe I just need to use AI. I bet if I went out to AI and said, make me a great intro to the show, we got to work at that. But with that said, what's new in your world?
Well, I was open to just hear that nice new intro to the show. What's new in my world? The bull market continues. That's what's new in my world. And well, football season's coming up, so for me that's best time of year. I get to start reffing football again. So I got some good things going. Had some client happy hours recently, so that's always a good time.
Tell me about those.
Well, it's a lot of fun to get together with clients, and over time, they kind of start to become friends, and we're taking care of their money, right? So I obviously care about them, so I want them to have a good experience. But it's awesome. It's a very low pressure way to get together, have a couple drinks, have some food, and hang out. And I don't know many people that don't like a free drink and a free meal. That seems to be pretty universally accepted everywhere.
Should we see if Molly wants to provide the happy hour link in the video?
No, because then just random people will be getting on my happy hour list.
I don't know. We'll see. See if anybody out there wants to get in.
I got a happy hour. Those are personal invites that I give to people to get enrolled into the email, the invite text.
Well, hey, something I want to talk about. We teased this up during the last episode. Ryan Dietrich posted this, that the S&P 500 on Monday, so that had been the 22nd. We're filming this on the 24th. On Monday, closed above its 20-day moving average for 60 days in a row. It was really close to going under the 20-day moving average. So the 20-day moving average is just the average of the 20 days. Going back 50 years, a run this long has only happened 4 times since 1950. But this is what I want people to tune into. The average gain a year later was between 20 and 26%. Investing on an all-time high today, the average gain 20 years, the average gain 1 year later is 20 to 26%.
That seems pretty good.
I mean, I think it's just more fuel. You mentioned in the previous episode that there's not a lot of headwinds out there. I mean, we're unwinding, tariff deals are getting done. The unemployment isn't shaky, but the labor market maybe is a little bit more on edge. Inflation's not increasing. And as these tariff deals and trade deals get done, it seems like the market clearly likes that. So I think that, this is pretty interesting insight as to what the market has done and what it might do in the future. There was only one instance that it was lower, and that was 1965.
Well, this time it's going to be different.
That's what they always say, but the most likely outcome is not that.
Yeah, and I think this chart and this, like the breaking the market down this way, it's another clue. It's another reason to believe the bull market has legs and can continue. I don't know. It's just the more data we get, the more things we look at, calls for the opposite just seem more incorrect. But that's the thing, right? We talk about people calling for big corrections all the time. They're going to be wrong, then they're going to be wrong again, and then wrong again. And then they will be right at some point. But
they were so late, it doesn't matter.
Right. And I don't think, personally, I don't view myself as someone who is, like a perma bull. when they use that term, oh, you're just always bullish, because I'm not always bullish on the market, but that doesn't mean I believe you should change your investment strategy. I believe that when you choose to buy that asset class, you're also choosing to live through the fluctuations of the asset class. So that doesn't mean I'm a perma bull, because especially the last couple of years, there's been times where I did not feel like the market was going to continue going up. Certainly and it got worse than what I expected, but kind of at the beginning of the year where we were at, and with more uncertainty, a lot of it caused with the tariff talk and all that. Like that's the type of environment that can bring that level of volatility and chaos to the market. Now, really meaningless event at this point, if you just stayed had you hold true to your convictions and your strategy. And I'm not saying that we could have an event, right? We can always have something that happens, but it's getting harder and harder for me to understand the bearish outlook at this time.
Well, here's why. The bearish outlook sells. Let me ask you a question. Who's more popular, Harry Dent or Tom Lee?
Ooh, that's a good question.
I'll bet it's Harry Dent.
Tom Lee's Tom Lee's on CNBC though.
Yeah, but Tom Lee's only really dialed into strategists, hedge funds, like money managers. Harry Dent appeals to anybody who wants to think the world's coming to an end.
So, okay.
You know what I mean? Like, because Tom Lee is the perma bull.
In the industry of financial professionals, Tom Lee is highly regarded, well-known, and respected. I think a lot of people just think Harry Dent's a scab. Now, in the world of retail investors, Harry Dent is probably more popular than Tom Lee, which is a tragedy in itself.
Elias, I'm going to venture to guess most retail investors have no idea who Tom Lee is.
So here's good advice. If you're listening to this and you don't know who Tom Lee is, you should go figure out who he is and read some of his research. Try and catch him on CNBC.
For sure. Don't watch Harry Dent, because Harry Dent's gone anyway.
I think anyone would benefit from that.
You made a couple points, though, about how to, you mentioned that we had an event in April, but I've been kind of playing this quiz on people. If people spent less time checking their account, they delegate this to an advisor, hire someone to do this for them, and you don't check your account. You just checked your quarterly statements. All you're doing. Hey, at the end of the first quarter, second quarter, third quarter, fourth quarter, I checked my statement. At the end of the first quarter, how'd you feel? Pretty good. Market was up. At the end of the second quarter, how'd you feel? Pretty good.
Yeah.
Market was up 5.5%, 6%. You didn't even know that April happened, because it all happened on April 2nd. And by the end of the quarter, it was all over.
So
just think about that.
I got a good story about that. So a client of mine the other day, he logged into his account the other day to look. The only reason I know is because he told me, because I saw him recently. And he's also a client that's gone a year without ever looking at his account. Like, I've talked to him before where I give him our formal review that we print. And he's told me this is the first time I've looked at my accounts for the last year and a half. So he's not, and in his words, he goes, I'm not a looker. I don't log in and look. And he goes, but I logged in the other day. He goes, I'm really glad I'm not a looker, because whatever happened in April, that didn't look very fun.
It wasn't fun.
And it wasn't, and he didn't even experience it. I mean, he saw what happened.
He saw in the world what was happening, on what the news media was pushing out. Markets are in free fall. People posting on Facebook. It's all crumbling down. I can't tell you how many Facebook posts people that it's all coming to an end. It's crumbling down. And guess what? It was all okay.
Yeah. So he did tell me that reinforced to him that he should just keep not being a looker, because he's happier that way. So,
well, and here's the other thing, like, people that are playing the individual stock game, you have to be a looker, because the individual stock game is different than the diversified portfolio game. A diversified portfolio, when I say that, I mean a portfolio built of low-cost ETFs, mutual funds, etc., pooled investments, not a portfolio of individual stocks. Because history's shown us that if you buy good investments, good mutual funds, ETFs, index-type investments, and you hold them for a long period of time, they tend to come back. When things go down, they do well over time.
Mm-hmm.
That's not a guarantee with a stock. You could have a stock that goes down in value and never comes back. So
yeah, companies can go out of business.
They do. Companies go out of business.
Do. Yes.
It's not that they can, that there are companies that are going to go out of business. So I think it just helps people keep the eye on the ball when you just say, hey, remove all this looking, delegate this out to somebody to help me do it that I know isn't going to go out and start buying individual securities and try to get too fancy because we think we're going to get some outperformance. There's other ways to get outperformance if that's what you're looking for, but still take a diversified portfolio mix to do that. Right? You still have to take more risk. Like you're not outperforming the stock market without more risk. That's just in general. You have to have a little bit more risk,
That
but
is true.
A lot of people can handle that. Just in general though, people just make mistakes with their finances. And I ran by a Kiplinger article about Dave Ramsey and calling out the 5 money mistakes. And we're supporters of Dave Ramsey. We think he does a lot of good for people out there. With that said, I thought we'd run through these because we share some of these same views in this space. And one of the number one money mistakes we see people make, and I'm going to gear this more towards retirement than, pre-retirement. People going into retirement and they don't have a budget because they've never had to have one. They were always responsible with money while they're working. They spent less than they made, and they never really had they had a mental budget, but it wasn't like I'm allocating 20% to this category and I only get $18 for, out to eat this week, whatever it is. But when people go into retirement and they can't tell me how much money they're spending, that actually becomes a problem. Because when you're working, if you make a money mistake, you can recover from it. You buy a car you can't afford, you could work an extra year, you could get a part-time job. Once you're retired, it's really hard to recover from a money mistake. The other thing about not knowing what you're going to spend in retirement is how do you actually put together a game plan?
If you don't know what you're going to spend,
yeah,
you don't.
Yeah. And here's what happens. Then we put the game plan together. If you tell us you don't know, and we say, well, if you plan on living till 90 or whatever age we use based upon the individual circumstance, this is the maximum amount of money you can spend each year and still have a high confidence level that you're not going to run out. And then we give them a budget. And that's totally fine if somebody who doesn't want to figure out what they want to spend. But here's the real problem with it. It's not going to provide the most fulfilling retirement. Because we're assuming that these individuals are going to spend the same amount of money when they're 80 that they are when they're 62 years old. And it's just not reality. That most people at 80 cannot do the same things, don't have the same energy level, don't have the same mobility that they did when they were 62. And so I'm kind of spinning this into retiree world. If you don't have a clear vision of what this looks like, you should really spend some time fast forwarding and saying, what does retirement look like? What are my goals? What are my priorities? And take those and really mesh them into a really good game plan to bring a high level of confidence and enjoyment to those early years of retirement.
Yeah, and I suppose you could do it one of two ways. If you had all that worked out, and I guess it's possible someone could say, well, I don't know what lifestyle I can live. And then we give you some sort of maximum spending number, then you can start to craft it. I guess that
happens all the time.
Yeah,
I have people all the time. They're like,
to
I don't know
get
what I'm
people
going to
on the
spend.
right track.
And they want to
But
know.
it is, yeah. And a lot of times, the more they understand our philosophy on that and just how it works, I think then they do want to spend more in their earlier years of retirement. And I think they feel confident in doing that. But I mean, to your point, I think that's one of the bigger hurdles for people to retire and it's a good question to ask people. Walk me through your first year in retirement. What are you going to spend your time doing?
And Elias, it shouldn't happen when someone's 59. It should happen when someone's 39.
Yeah.
Because you have to start to set your savings rate to match with your goals and priorities. Just think, if you're 39, you say, hey, I plan on having a second house in Florida or Arizona or wherever it's at. Okay. What's the game plan to get there? Versus I'm 59. I haven't done any of the prerequisite work or planning. I think I'm going to buy a place in Florida. Well, what happens then? It either works out or it doesn't. Like the numbers work or they don't. Where if you give somebody 10, 15, 20 years to plan, most of the time, if you execute it, it will work out. But you don't know what you don't know.
Yeah. And I thought you made a really good kind of along the same scenario on our radio show the other day, talking about how, maybe a second home, you should plan for owning it for a certain amount of years. And I'd never really thought about that. A lot of times in my mind, someone wants to buy a second home, they're just planning on keeping it forever. But it is more realistic to think, okay, I'm going to retire at 60, get a lake house, a place in Florida, whatever it is for my family to enjoy. But then I'm going to plan on selling it at 75.
Yeah. So I think you're referring to, we had on our radio show that we host, which we'll put a link to that if you guys want to catch our radio show. It's pretty good too. We have some other advisors, different personalities. But we had a listener question and they were in their early 50s and they called in and said, hey, we're trying to decide whether we should buy this lake house or not, et cetera, et cetera. How does it affect our retirement? And my comment, what I always ask people in this situation, one, will you buy this when you retire? And if not, then maybe now's the time. And I kind of shifted their mindset to think, a lot of people think when they buy something, they're viewing that second house as an expense versus an asset, right? If they were buying
lifestyle investment,
right. But it's really not. It's a lake house is not. It is real estate. It's a real estate investment. It is different than a stock market investment, but it's still an investment. It's something that's not going to go down in value because
and it's
generally
also not your primary residence.
Right. Because what is the definition of an investment? Something that generates dividends, income, or capital gains. So in the case of a lake house, it would be capital gains in the future. And the question I posed to the listener is, are you going to buy this for a set period of time, or is this a forever purchase? And I think as human beings, we get anchored to the idea that when we buy something, we see it as permanent. This happens all the time.
Which is really silly.
Even, I'll give an example. My wife was picking out a car. It's like 5 years ago. Just making sure everything was perfect. I'm like, if it's not perfect and you don't like it, you can get a new one. But she saw that purchase, that's a permanent purchase. Well, sure enough, guess what? She had it 4 years. She has a new car. It's the same thing with that lake house. I said to these customers, are you going to keep, or I guess call an individual, are you going to buy this and could you sell it at 75 or 70 and take the cash infusion and put it back into your portfolio? Like, you don't have to assume it's gone because it's not your primary residence. But that's, you know what that is, Elias? That's seeing what's in plain sight and finding it for somebody. The idea that that's what we do for people. We try to come up with creative ideas that they haven't thought about. And you hadn't really even thought about that. But those are some of the things.
No, but I did think that is a great solution or strategy. And you could actually, you could plan for it because you could even assign some sort of appreciation to the property. I mean, you don't got to get crazy and say it's going up an unrealistic amount. But if you assign,
just say it goes up 3.5% a year.
right? If you assigned what that area has just appreciated over a long period of time, you're going to be in the ballpark. So you could actually kind of even like you could do a cash flow. Or, I'm not saying the client's not going to do that, but you could absolutely do that.
You know, it reminds me, you remember I had some customers that they had pretty good 401k, but they had a farm too. And they kind of overspent the first 6 years of retirement. And we had the meeting and it just said, hey, you know, at some point, if you keep up the spending, are you willing to sell the farm? And their answer was yes, we're willing to sell it, because I told them their spending was not sustainable without that farm. And when we originally set the plan up, they did not want to sell the farm. If you remember, we had them back for the meeting. We had them back for the meeting and just said, hey, what you're doing will work if you're willing to sell the farm. They said, okay, well, you tell us when we need to sell the farm. So about 6 months before they needed to sell the farm, we called them, and guess what? They already had the farm for sale. But that's the same idea that, hey, we broke this into different segments and we had this big cash injection. And for some people, actually, it could become a safety net. Like if you had that, you know, for some people, maybe people who aren't as good with money, if you had an asset that's not readily liquid and you went through all of your money, there's this other safety net we get to inject at 65 or 70 or 75 years old, just like we did for those customers, because not everybody sticks to the plan. Like we can lay out the basics, but at the end of the day, it's their money and they can spend it how they choose. And it's our job to navigate and help it, you know, be sustainable for as long as possible. But I think also, you know, this is one of the second money hurdles or money mistakes that, you know, really try to avoid. It's impulse buying. Impulse buying is probably one of the killers of retirement savings and retirement accounts. And when I say impulse buying, I don't mean impulse buying on large purchases, because those are conscious decisions. You don't impulse buy most people don't impulse buy a $60,000 car.
No.
But what do you impulse buy? The $400 pack of Legos, because you want to put together a Lego tractor, whatever it could be. Yeah. Like, oh yeah, we're going out to dinner. We spent $300. Impulse buy. You didn't think about it.
The bags of candy that the grocery store puts in the fruit section because they know you're going to be walking through there with your kids.
Tootsies.
Yeah,
it's my favorite candy.
That's an impulse buy for sure. But yeah, I think, okay, the impulse buys, which, I mean, now that's even evolved now. It's not just in-store psychology like it used to be now. It's even the online shopping.
No, the impulse buys don't happen in store. You're right. They don't happen in store.
Well, they happen in both places. People are impulse buying everywhere they go.
Yes, but it's less. The impulse buy, I'm going to tell you what it is because I'm a victim of it. Because the marketing is so targeted now. You're on social media, okay? And I'm scrolling through and I watch a video, a guy fishing, talking about this fishing pole he has. I'm like, man, I got to get that. I need that. He's fishing exactly how I fish, doing exactly what I want to do. Tell me how great this is, so I buy it. And I get it. I'm like, yeah, it's okay. And I don't ever use it again. Or there's a new lure out. Or there's a new cell camera for hunting. And they're so good at marketing on social media. They're like, I have to have it. Amazon.
They've made it safe to say you could never purchase another tool to help you fish and you would never run out.
Yeah. Including fishing line.
So every single thing you buy is an impulse buy for that hobby. I'm sure there's stuff that you need, but
there are things I would need to buy because I use them very regularly.
Yeah.
Like little plastics, but they're like a $3 package. It's not a $200 fishing rod. Like I don't need more of those. Do you remember Gander Mountain in town here?
Yes.
Okay. They went out of business like 7-8 years ago.
Yeah.
At the end of the sale, it was 80% off because they were going out of business. Just clear the building. Right. And I went in and I found the store manager. I said, I want every single fishing hook and sinker you have. Like, and there were specific ones I wanted. He goes, well, I'll sell you those for that price. I offered him a price, which was less than what, or, you know, it was more of a discount. He goes, but you have to take everything at that price. It was basically, I was buying everything at 10 cents on the dollar, but you have to take everything. Every hook, every sinker they had. So guess what I did? I took everything. I have bass hooks. I will never buy another fishing hook for as long as I live.
You made that guy's day. He's like,
well, yeah, because I cleaned the place
I
out.
want this stuff out.
Okay, Elias, the receipt. At the time, I had a Chevy Avalanche. Okay, you know those are like a truck, right?
Mm-hmm.
My receipt was as long as because they had to ring out every individual item. It wasn't like they packaged everything up and gave me a price. They rang every item out, right? The receipt was as long as my Avalanche times 4. I don't know how many items were on it, but to your point, that was definitely an impulse buy. That 90% of it I don't need, and I probably won't use in my lifetime. I have sold some of it, but a lot of times if I have a buddy going to Canada, they'll come over. I'm like, here, take these, because I had them for free anyway. I had a guy come over one time. He goes, you have more than the local fishing shop, which I probably do. Like unopened in packages. I digress. That was an impulse buy, but I also knew that I had future benefit in use of it. But I buy tons of impulse stuff. I've been trying to not buy on Amazon because I see something. It's actually been going pretty good. So I see something, I'm like, I need to have that. And what happens is just have all the stuff.
Yeah. Stuff is great. All right. What are the next couple things?
3, not having emergency savings. In our opinion, this is probably the number one, money mistake people make. If you don't have an emergency fund of at least 3 to 6 months of your expenses, you're really skating on the edge. You're skating on the edge of debt. That's what it is. You can be debt free with no emergency fund.
Thin ice.
If you don't have an emergency fund, at some point you're going to be borrowing to pay for it likely. And, the number one goal is to not have to borrow to pay for an emergency. One of the things I see a lot with emergency funds are people look at these funds and they think it's the slush fund. It's not the emergency fund. So what is an emergency? An emergency is my water heater went out. Not I need to retile my bathroom.
No, that's a new bathroom. That is an emergency.
Well, our toilet.
I'm kidding.
I mean, yeah, but people, that's what they use their emergency fund for.
Yeah.
Then some event happens and it's gone.
Yeah. Got a leak in the toilet. Let's remodel the whole bathroom.
No, you're exactly right.
Here's a question, and I'm going to throw this one out. Don't
get me in trouble, dude.
Well, because no, you won't get in trouble, but one of our listeners, he's a pretty consistent listener. His wife wants to build a pool. So would you be okay with someone using emergency funds to build a pool in their backyard? And I'm going to preface this. He has a perfect backyard for an in-ground pool. Very big, flat lot. It would be amazing.
How much is in his emergency fund?
Well, let's just assume that it's...
Is it 3 or 6 months?
Let's assume it's 6 months emergency fund.
How old are they?
Mid-50s.
How much is in their 401k?
Plenty. Like they're good savers. They've done a good job.
Employed?
Yep.
Business owner?
Good jobs. No, don't own business.
Good job?
Good job.
Can they live on one person's paycheck?
Ooh. I'm not sure. That's a good question.
So, because the fear is that one person would get laid off and then if you can live on the lowest paycheck, right? We still want an emergency fund, but maybe you don't need 6 months.
Right. Or maybe you have a 12-month emergency fund.
Right. So I would say it's not an emergency, so probably not. But at the same time, if their savings rate is right, they can live on the lowest paycheck if somebody loses a job. They don't have any other debt. They could lower their emergency fund to 3 months in that case, put it in, and then once it's in, build that emergency fund back up because they still have an emergency fund. They just change the parameters of it. And especially if they have good 401ks or financially responsible. Because in my world, I'm never owning a house without a swimming pool. Ever.
Well, that's what
because
happens.
It's a lifestyle investment.
That's what happens. You have a pool. I also have a pool. Once you have a house with a pool, you just can't even, like, I can't picture myself not having a pool at the house. And I'm sure if I go buy a different house, and I'm sure the next pool is going to be more expensive and I'm never going to get that money back.
It's not about getting it back. It's about last night. It's 6:45.
I don't care. Right. That's what I'm saying. I don't care about all that. I can't picture not having a pool.
So to answer your question, you can't spend all of your emergency fund, and there's a lot of other factors that go into it.
Right.
But if they could live on the lowest paycheck, they had enough of this emergency fund, which if they have enough in the emergency fund to write a check for a pool, I'm assuming in-ground pool.
Yeah. Yep.
Then they have to have at least 12 months. Because the in-ground pool where we're at is 100 to 120,000 by the time you do the concrete work.
Right.
Everything else. So unless they're making 30,000 a month, and then if they're making 30,000 a month, guess what? Just wait 3 months. It's the end of the season. Save up and do it next spring.
Yeah. Well, hopefully if they do listen to this episode, that you help bring some
Are they
clarity
customers of yours?
No.
Just friends of yours?
Friends that listen.
They might be customers of mine soon.
They might be.
And then,
might be.
Guess what? Number 5 is lifestyle creep. I don't consider a pool lifestyle creep, by the way. That's a lifestyle investment. But lifestyle creep does happen to people as they make more money. They spend more money. We've talked about this a lot. One of the best things you can do to avoid lifestyle creep is when you get that 5% pay. Let's say you get a new job where you went from $150,000 to $200,000. That's roughly, a 30% pay increase. Well, what if you increased your savings by $20,000 a year and you took the other pay increase to go to your lifestyle?
Nothing wrong with that.
No, the key thing is when you make more money, you need to increase your savings rate versus just pocketing all of the money.
Yeah, and I'll take the flip side of I think there's 2 sides to lifestyle creep. One, there's a huge segment of people that they can't afford to have lifestyle creep. There are also people and families out there that, they're not making these other 4 mistakes that we've talked about, right? They're in control, their impulse buys, they have an emergency fund, they're saving the right amount of money, they're not abusing credit cards. If you're hitting all the basics and doing everything right, it's okay to enjoy more lifestyle throughout time.
For sure.
What it's not okay to do is enjoy more lifestyle and facilitate that through a credit card and through accumulating debt to do it. So lifestyle creep, although I do agree it is something that holds a lot of people back, I do think it's something that if you're financially responsible and you're doing all the right things, don't be ashamed of lifestyle creep. And you want a little bit nicer car, get it. You want a pool at your house, get it.
Yes. So I think people view lifestyle creep as all or none. What you're saying is, and what we're both saying is, enjoy more lifestyle, but make sure you increase your savings with it, because here's what will happen if you don't increase the savings rate too. When you're 65 or 60, whenever you retire, if you don't increase your savings rate commensurate with your pay increases, you'll never be able to save enough money to keep your lifestyle the same.
Yeah, and then you're looking at stopping working and reducing lifestyle. People don't do that. People will continue working.
There's only one thing worse than running out of money, dude. It's running out of lifestyle.
It's not the same thing.
It's way more. It's way harder to run out of lifestyle.
Yeah, because you could still have money but not be able to live the same lifestyle you used to. Yeah,
but if you're out of money, you're out of money. You don't have a choice. Running out of lifestyle is worse than running out of money. You're out of money. Your lifestyle's over. But if you ran out of lifestyle and still have money, that's kind of a bummer.
But you don't have, that would be worse. Now you don't have enough to have what you're accustomed to. Yeah, that'd be worse.
And you still have money. Because here's the challenge with that. Eventually you will run out of money. Once you get a lifestyle, it's really hard to give it up.
Yeah.
With that said, I want to thank everybody for listening. If anybody out there has a listener question, we'd answer it for you. I know Elias brought that one up with one of his friends who listens to the show. If you are that friend and you want some solid advice, you can become a customer of mine instead of Elias's. Just give you a chuckle on that.
They might take you up on that.
If you're looking for any help, you can go to btwellshow.com, click the link in the description. We look forward to you guys tuning into the next episode. Thanks for listening.
The opinions voiced in this show are for general information purposes only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, and financial or tax advisor prior to investing. Premier Investments and Wealth Management and LPL Financial do not provide tax advice. Please consult your tax professional. Economic forecasts set forth may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. There's no guarantee that a diversified portfolio will enhance overall returns or outperform a non-diversified portfolio. Diversification does not protect against market risk. Rebalancing a portfolio may cause investors to incur tax liabilities and/or transaction costs, and does not assure a profit or protect against loss. All performance referenced is historical and is not a guarantee of future results. All indices are unmanaged and cannot be invested into directly. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risks, including possible loss of principal. Rebalancing a portfolio may cause investors to incur tax liabilities and/or transaction costs, and does not assure a profit or protect against loss. Dollar cost averaging involves continuous investment in securities regardless of fluctuations in price levels. Investors should consider their ability to continue purchasing through periods of low price levels. Such a plan does not assure a profit and does not protect against loss in declining markets.